Hello and welcome to CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra. With me is Pavitra Parekh and you're watching MF Corner. Well, inflation has cooled and interest rates are likely to be steady if RBI in its meet this Friday does not raise rates. Does this scenario make it good to look at the debt category, and does it make this category all the more interesting? Debt funds do provide some diversification, but they are sometimes cyclical because of the interest rate cycles that we are in. So we'll discuss all of that, some risks associated with debt fund investing and a lot more.
Well, absolutely. And there's so many subcategories also, right? So it would be helpful to get an expert in on this right now. Let me welcome our guest. Sandeep Yadav is Head of Fixed Income at DSP Mutual Fund, and he joins us now. Sandeep, thanks a lot for joining us. And this is the first time we're speaking, so welcome to MF Corner. You know, like Sonal was mentioning, we're at an interesting time. Inflation has cooled. Rates are expected to hold at these levels for a while now. So how do you look at the debt mutual fund space right now in this scenario?
Well, you are absolutely right. Inflation has cooled, and also. But frankly speaking, in India, inflation is quite volatile. So 50% of our inflation is driven by food. And we have seen inflation come down. We have seen it rise up also. So in such a scenario, where inflation is already quite volatile, we believe that there are other factors which are playing on the debt funds, or rather yields, which will bring yields lower. And we look at the fiscal policy. As I think Sonal rightly mentioned, debt fund itself or yields themselves are very cyclical, and we are literally at multi-year high in yields terms. So we see yields coming down, and we think that debt funds are very lucrative in current scenario as the yields come lower.
Okay, so debt funds could be the thing to look at right now, considering the yield cycle that we are in. So what are some of the important things one can focus on when it comes to investing in fixed income funds? Say if a retail shareholder is looking at it, it's slightly more complex than the equity funds, right? So what would your advice be?
Well, I would certainly say that they need to track the RBI policy rates. They need to see the interest rate movement of the RBI. Apart from that, I would also suggest that look at fiscal policy, and it suddenly becomes a little bit more difficult to look at the fiscal policy for a retail investor. And I would presume that looking at the budget and looking at the headlines right after the budget gives a good sense to retail investor on how the yields would turn out for the next 1 year. Lastly, retail investors, when they invest in equity, do look at how global yields are going, how the global indices are moving, and how the global indices, equity indices are moving. And I would expect them to track the global yields also, because global yields, frankly speaking, impact Indian yields as much as probably how the global equities impact the domestic equity.
Okay, got that. But Sandeep, let's go back a step and just talk about this entire, aspect of investing in fixed income in the first place. Of course, we know that it provides a diversification. It sort of is a lower risk way of investing, and you don't want to be completely in equities. But there are multiple ways of taking exposure to debt markets as well, right? I mean, you could look at fixed deposits as well, which is what a lot of retail investors tend to do. So you want to take us through the different ways in which you could just get exposure to debt?
Absolutely. As you mentioned, fixed deposit is probably something which nearly each of the investors has sometime or the other invested in. Apart from fixed deposit, of course, there are debt mutual funds where, and I think the third part, which RBI has done a very decent job in the past few years, is for debt investors to directly invest in direct bonds. Having said so, there are pros and cons of all these three avenues. For the fixed deposit, while you can invest in fixed deposit, but you can't really exit when yields go down and exit with capital gains. The debt mutual funds and the bonds, direct bond investment, give you that advantage. However, on the other side, direct investment in bonds can be quite difficult or operationally difficult for many of the retail investors. So these are the pros and cons, and probably all three of them give you the right exposure to the debt, but some of them give more liquidity and easier exit and entry levels.
Okay, so what is the most liquid out of the three, if you can give us a sense in terms of ranking?
So I would clearly say that operationally most easy is probably fixed deposit, because all of us have done it once in a while in our lives. Liquidity, if you were to ask, I would say that debt funds are probably the most liquid. One click of a button and you can actually exit all your investments. Bond investment can, as I mentioned, can be operationally a little bit difficult, and trying to find liquidity when you want to exit may end up being difficult, though it's not necessarily so, but probably I would rank direct bond investment to be the most illiquid.
Okay. So, Sandeep, take us through how does one really go about selecting which debt funds they should look at based on the investment tenure? Because this is a segment which anyway has a lot of subsectors, right? So, even if you're a short-term investor, there are multiple ways that you could invest. You have everything from an overnight fund to a ultra short duration fund to a short duration fund. So, take us through that breakup as well.
Sure. So, I mean, debt investment itself is regarded as a defensive investment. And in a defensive sector like debt as well, you can have a defensive category as well as aggressive category, just like you have in equities, a defensive sector as well as aggressive sector. So I would typically say that when yields fall, you want to be in a much more aggressive sector in a debt category, or rather aggressive category, and that would be a long duration, long tenor bonds or long tenor funds. I would typically say a dynamic bond fund category would be a very good category for that. Probably a medium duration fund category would also be a good category. However, as I mentioned, if you expect yields to rise up and probably you want to be in a more defensive sector, then go to shorter tenure funds. And as you rightly mentioned, probably overnight fund is there. I would not suggest overnight funds for retail investors, but probably they can go to liquid fund, ultra short fund, or even a money market fund. But currently, in the scenario that we are in, at least my personal recommendation to investors is that since yields probably have peaked and probably may come down in future, so probably adding a little bit longer tenure investments for capital gains might be the right time to add them.
Okay, all right. So considering the rate cycle we are in, you would recommend people to go for a slightly longer duration investment in the fixed income space. This is a little complex, right? So corporates and institutions are still a big part of holdings in fixed income funds. What's the reason for less interest by retail shareholders, something that you must have come across in your years of experience?
Well, I think the answer, at least to me, is quite simple. The fact is, nearly all of us have started our investment journey by investing in fixed deposits. And fixed deposits do give us a debt exposure. And suddenly there's too much of inertia to move from fixed deposit to debt funds, despite the different kind of characteristics or different advantages that debt fund might give vis-a-vis a fixed deposits. For a corporate, of course, the fact is they prefer more of a debt exposure because it is less volatile. But largely, I would say that because most of us have already invested in FDs, the inertia to move to debt funds is there, and it might take a little bit more time. But we see a lot of investors moving to debt funds as they see the advantages that debt funds have to offer vis-a-vis a fixed deposit.
Okay, got that. That will be good to see if you do see, a little bit more retail interest here. Sandeep, it's a very interesting chart and we have lots more questions. The risks around debt funds are also very different. You have to look at the credit picture, the interest rate risk, all of that. So we have all of those questions and we're going to come back in just a bit and take you through that. Welcome back. You're still tuned into MF Corner here on CNBC TV18, and we still have with us Sandeep Yadav, Head of Fixed Income at DSP. Sandeep, we've spoken about the ways to get exposure to debt, but take us through some of the risks that you foresee right now with this entire debt category. Is there anything that, from an investor standpoint, you would like to just be wary of?
Well, I think there are always risks in the markets. Yeah. I would say right now, if inflation does spike up, then we need to be wary about that, how RBI reacts to it. Similarly, the currency risk, as well as if global yields also start rising up, then that would certainly have impact on Indian yields. Having said so, these are the risks which I believe have already, at least the worst is behind us when it comes to these risks. What I would be rather more concerned about right now is what happens if India's domestic demand reduces and how the credit sector, how the credits work rather than duration risk. So that is something which I'll be more concerned about rather than just the interest rate risk right now.
Okay, all right. So we'll discuss the other risks in detail, what are generally around these debt funds. But Sandeep, usually when we talk about equity funds, there's a process which people generally know that fund managers follow. But how do you as a fund house choose which corporates and credit bonds to invest in? What is that entire process? We would like to know that.
So I believe our process is quite rigorous from that respect. We've got a multi-step process where, at any step, any of the companies can be vetoed out or other investments. So an analyst generally speaks to or converses with the management. We look at the business and the financial numbers. We also look at how the news and the regulations are changing. And based on that, an analyst usually recommends whether to invest or not to invest in a company. Having said so, this is just the first process. Usually a credit committee, in fact, always a credit committee analyzes analyst recommendations and decides whether analyst recommendations have to be approved or not. And finally, even if a credit committee as well approves the investment in a company, it's up to the fund manager at the end of the day whether they are comfortable investing in a company. So literally in each of the steps, a company has to pass all these three hurdles to be part of the investment universe for us. And having said so, I think one typical thing which is very important in India is governance. We spend a lot of time on governance and just not on the financial numbers when we invest in a company.
Okay, all right. So it's a multi-pronged process, three-step investment process that DSP Mutual Fund follows when investing in the bonds and fixed income. Because, Sandeep, this is, as we have been talking about, very complex for retail investors. So always good to know what your fund manager is thinking at that point in time as well. Now, in that case, there are different sectors then. But what is your credit view on different sectors? Which credit cycle are we in? Are all the sectors doing well? Is there something that you think weakness could be seen?
Well, we have seen the best phase, probably, or a really good phase of credit growth behind us most probably. So after the COVID slowdown, we saw most of the companies really doing well. We saw a lot of credit expansion, credit takeoff happening. Probably the best scenario is behind us, and we believe that going forward, as the domestic demand comes down, we'll see a little bit weaker numbers in the financial sector. So that is something that we expect. On the other hand, we will see global economies slow down. We also know that China is supplying a lot of like a lot of products. So certainly the products which are or companies which are invested more in demand supply driven dynamics, that we are a little bit wary of. For example, chemicals could be one sector. And having said so, while these are a few of the sectors that we are worried about, demand supply driven as well as financials, having said so, I don't think there's any red flag that we see in any of the sectors right now. The economies are doing very well, the companies are doing very well. And even in the sectors that we are a little bit cautious about, we believe that they are really good companies to invest in.
Okay, got that. That is how you would go about the stock selection, the debt selection process. Sandeep, what are the risks generally with the debt category? Like I was mentioning, it's very different from equity. You have to look at the credit risk, the interest rate risk, the currency risk as well. So just detail that for our viewers as well so that they get a sense of, what they should be mindful of.
So especially for the retail investors, the way I would categorize risk is you'll have a linear risk or a binary risk. So linear risk would be something which is quite transparent, which you can clearly see in your daily returns. If there's something which has moved in the markets, you can clearly see in the daily returns. On the other hand, probably credit risk and illiquidity risks are the risks which are not so transparent. You may not be able to see them turning negative in your daily returns, but they would probably be a binary event and suddenly you will see losses happening. So suddenly these disruptive risk, which is credit and liquidity risk, are a little bit difficult for a retail investor to gauge, especially if they're starting with the debt fund. So I would presume that these are the two risks, and at least we are personally very cognizant about the latter risk, which is the disruptive and the binary risk that I spoke about. And I believe so should the retail investors.
Okay, that is helpful to know. Sandeep, we do have that big event upon us this week itself. We are going to see the monetary policy by the RBI. What are your own expectations in terms of what we could see this time and, maybe in the coming few policies as well?
If you would have asked me the same question before the last policy, I'm telling you, I would have got it completely wrong. And probably most of the people would have, because RBI did throw a big surprise to the market when they announced open market operations to suck out the liquidity. Right now, since last 2 months, what has happened is probably inflation has been quite benign, but we have seen global yields fall quite a lot. We have seen the risk to the currencies abate. So it will be interesting to see how RBI tackles, because suddenly what RBI was expecting 2 months back is not how things have really panned out. Liquidity has remained consistently tight. So going forward, of course, we expect rates to be stable. We don't expect any jarring announcement by RBI. And I think it will be status quo, literally, be it stance, be it rate actions, or be it even the concerns that they showed about liquidity and inflation, because I would not think that RBI would want to flip so quickly after the last policy.
Okay, we take your point, Sandeep. Thank you so much for joining us today and explaining everything about debt funds and how you as a fund house is looking at this category as well. And most importantly, what we are expecting from the big event that's coming on 8th of December. So thanks a lot. It was a pleasure speaking with you today.
Thank you so much.
Okay, all right. With that, we'll do one thing. We'll move on and talk about something very interesting. Artificial intelligence, or AI, definitely has been the talk of the town for all the right and sometimes the wrong reasons. But as an investor, should you consider this segment? Pavitra has gone to the big wall. It has the data on how one can take benefit of the AI wave by investing in mutual funds which have an exposure to the massive technology shift. Pavitra?
Well, it's been all about the new world of AI and things are only getting hotter. So how do you as an Indian investor really play this theme? Well, there are 8 companies that have broadly been identified as being part of this hot AI pack. These include Alphabet, Amazon, Meta, Intel, Nvidia, a few more. I've put them all in your screen over here as well. So you could look at getting exposure to this AI theme via 2 ways, right? Either you look at the passive route or the active route. Now, Value Research has shared some data on the funds that have the highest AI exposure. So let me just go through the passive basket first. Motilal Oswal Nasdaq 100 ETF leads the lot in terms of the money invested. So they've put in a little over 2,000 crores and the AI exposed stocks make up a third of the total fund. Now the Mirae NYSE FANG Plus has around 760 crores and the scheme allocation is pretty heavy. So the scheme allocation to these AI stocks stands at over 50%, 51% there. The Motilal Oswal S&P 500 Index Fund has around 530 crores invested, and these AI names, in terms of the allocation, look at around 20%. Then you have the ICICI approved Nasdaq 100, which has 284 crores and around 33% in allocation, followed by the Mirae S&P 500 Top 50 ETF with almost 200 crores invested for a 35% kind of allocation. So these are all of the passive funds. Let me also talk to you about the actively managed funds now. And the AI investment here is highly concentrated, right? So if you look at the top few funds, all of them, just the top 5 in total, hold around 88% share of the total investment, which is worth roughly around 12,000 crores. Within this basket, you have Pavitra Parekh FlexiCap Fund, which has nearly 7,000 crores invested. The scheme allocation to AI stocks is 16% over here. Then you have 3 funds from the SBI Mutual Fund group, which are pretty decent exposure, right? So the SBI Focus Fund has around 2,000 crores in these companies. It's a 7% allocation there. The SBI FlexiCap has around 730 crores, like you can see. It's a 4% allocation for that fund. And lastly, SBI Magnum has invested 671 crores for an 11% allocation. So those are the SBI group of funds. Lastly, you also have one from the ICICI approved Blue Chip, which has invested around 133 crores, and the AI exposed stocks allocation is at 5%. So those are all of the numbers. Just some interesting points that we are picking up is that there seems to be a very clear preference within the actively managed funds for Alphabet or Google. So 4 of these 5 funds that I mentioned have invested in Google. Also, none of these 5 active funds have any exposure to the Nvidia stock. So that's something that really stands out to me as well. But those are the funds which are putting in the cash and giving you a way to hold this hot AI pack.
Okay, all right, riding the AI wave. Those are some interesting names that you put on board, Pavitra. Thank you so much for joining us. So those are some of the funds via which you can take exposure to this wave of artificial intelligence and the investing in that particular segment as well. Well, with that, we'll take your leave on this edition of Mutual Fund Corner, but you stay tuned. Closing bell comes up next. It'll take you through the last hour of trade.